Financial Times, the New York Times business section speaks to the fact that these stress tests are getting weaker. Let me ask another question. Vice Chairman Quarles has given two speeches outlining how the Fed wants to recalibrate the rules for large foreign banks. You gave an answer, a carefully worded answer, I thought, to obscure the fact that large foreign banks may receive less oversight as a result of 2155. The public's getting mixed messages from the Fed. For the record, can foreign banks with more than 50 billion in U.S. assets, Deutsche, Santander, Credit Suisse, the others, can foreign banks with more than 50 billion in U.S. assets, can they expect to get regulatory relief during your tenure?
I think I can say that 2155, it's not clear to me how it provides regulatory relief to those firms. I mean, all of the banks that have 50 billion in U.S. assets have more than 250 billion in global assets. So I don't think there really will be much effect. I won't say that we'll never do anything to provide regulatory relief to a group during my tenure. But
so your position seems to be that if they're over 50 in the U.S., under 250 as those are, but much, much, much bigger with all the globally, that you don't expect any regulatory relief for them?
Well, the main thing is the $50 billion threshold for internal holding companies will remain the same. We're not looking at that. So I think they won't see much difference.
Physical commodities, the Fed proposed physical commodities rule from 2016. You are moving presumably to finalize it. The Fed responded to questions for the record saying that the board continues to consider this proposal. When can we expect action on it, Mr. Chairman?
I don't have a date for you on that. I know that we received extensive comments on it, and we're considering them.
Do you feel some urgency on it?
I'll have to go back and look and see where that is in the line.
If you would please respond in writing to that. And last question, Mr. Chairman. The administration and some in Congress pushed through tax cuts and bank deregulation under the guise that it would trickle down to American families in the form of more loans. Loan growth has slowed in the last quarter. It was less than half the growth rate than during the last year of the Obama administration. The four largest banks, as you know, redirected record levels of profits into dividends and stock buybacks. The four big bank CEOs got an average raise of 26%. My question is simple. When, if ever, do you expect to be able to come before this committee and demonstrate to us in this committee, as chair of the Fed, demonstrate to us how tax cuts and deregulation have actually benefited the real economy in the forms of more lending?
I guess I see my role as reporting about the overall economy rather than the effect of any particular law on it, although I'll be happy to take questions on that.
Okay. Thank you, Mr. Chairman.
Senator Scott.
Thank you, Mr. Chairman, and good morning, Chairman Powell. Thank you for being with
Morning,
us
Senator.
today. It certainly is difficult to find negative news as it relates to our economic reality. The truth of the matter is that we're in the third largest economic expansion since 1854. Not 1954, 1854. 18-year low in our unemployment rates. African-American unemployment for the first time in recorded history below 6% at 5.9%. Hispanic unemployment at 4.6%, lowest recorded as well. Wage growth 2.7%, the highest level since 2009. And the Atlanta Federal Reserve suggests that we could have a 5% GDP growth in the second quarter. And the good news just keeps on coming. Small businesses that they have not been this optimistic in 45 years. Got to be a record. Beyond a doubt, tax reform combined with responsible regulations have resulted in more Americans having more money in their pockets. And another great example of the economic reality that we face today is that the core prime age labor force participation rate has stabilized since 2013 and is starting to climb in the right direction. My question for you, Chair Powell, is what's been the overall impact of the economic growth for the long-term unemployed, and can we read into the prime age labor force participation rates increase really positive news for those long-term unemployed?
Yeah, so prime age labor force participation, Senator, as you pointed out, has been climbing here in the last couple of years. That's a very healthy sign, and because prime age labor force participation is really, it's been weak, and it's been weak in the United States compared to other countries. So it's very troubling, and the fact that that's coming back up is a very positive thing. We really hope it's sustained, and we hope that these gains in participation can be sustained. We have a long box in our monetary policy report that talks about that. Yeah. The other thing you mentioned the long-term unemployed.
Yes.
So the number of long-term unemployed has come down dramatically since, I don't know, maybe 2010. I want to say the numbers were between 6 and 7 million. And unless I get this wrong, I think that the current number of longer-term unemployed is around 1.5 million. So it is the people who are on the very edges of the labor force, like those people, those are the ones who've benefited the most.
Thank you. With all that economic heat coming our way in a positive way, the prices seem to be going up. So the CPI rose 2.9%, the fastest pace since 2012. Those rising prices could negate some of the wage growth that I just talked about if left unchecked. In the past, we've discussed, you and I, the Fed role, according to the congressional mandate, seeking stable prices being one of those specific mandates. We've also talked about the downsides of low interest rates for extended periods of time. What do you see in the prices for energy, housing, healthcare, and transportation, and how is that going to impact your thinking moving forward?
Inflation has been below our 2% objective since I joined the Board of Governors in May of 2012, just until last month. For the first time, we have 12 months of core inflation being at 2%. So that's a very positive thing. We want to see overall inflation continue to come up so that it's sort of symmetrically around 2%. I'd say we're just shy of achieving that, but we want inflation to remain right around 2% and be as likely to be a little above as a little below. I'd say we're on the, and I think our monetary policy is really designed to help us continue to achieve that. So we're gradually moving up rates.
Yes.
And that, we think, is the policy that will help us get inflation to 2% sustainably.
Thank you. Just two more areas for you. South Carolina, my home state's economy is built on trade. You name it, we make it. We grow it and we ship it. Cars, cotton, tires, jets, peaches, soybeans, turbines, solar panels, and the list goes on and on. What's generally happened in the past to economic growth when we've raised tariffs?
So I have to start by saying that, I'm really firmly committed to staying in our lane, and, our lane is the economy. Trade is really the business of Congress, and Congress has delegated some of that to the executive branch. But nonetheless, it has significant effects on the economy, and I think when there are long-run effects, we should talk about it and talk in principle. And I would say, in general, countries that have remained open to trade, that haven't erected barriers, including tariffs, have grown faster, they've had higher incomes, higher productivity, and countries that have gone in a more protectionist direction have done worse. I think that's the empirical result.
I only have about 5 seconds left, so let me use my time wisely. As you know, I have a background in the insurance industry, and I am seriously a fan of a state-based system of insurance regulations. I think it's the best in the world. As the Fed participates in developing the ICS with the IAIS, I strongly urge you to shape a final product that protects the U.S. system of insurance regulation, and I would appreciate you and I having a conversation in the near future.
Thank you, Senator.
Thank you. Thank you, Mr. Chairman.
Senator Reid.
Thank you very much, Mr. Chairman. Welcome, Chairman Powell. The issue of wages has been discussed by several of my colleagues and yourself. In 2000, the last time we were at this situation where we were touching 4% unemployment, the share of national income by corporations was about 8.3%, and the share in wages was 66%. Today, we're once again reaching that point of about 4% unemployment, yet corporate profits account for about 13.2% of national income. They've gone up significantly. Wages as a share of national income going down from 66% to 62%. If those trends continue, we're in a situation where working men and women are not going to get their fair share of growth. What are you trying to do at the Fed to ensure that they get their fair share of growth?
The decline in labor share of profits was generally, oscillating fairly constant for a long number of decades, and right around the change of the turn of the century, began to drop precipitously and continued to do so for more than a decade. It's very troubling. We want an economy that works for everyone. And that happened, by the way, in essentially all advanced economies, and probably a range of factors are responsible for that. In the last 5 years or so, labor share of profits has been sideways. This is very much akin to the flattening out of median incomes over the last few decades. So it's got to do with a number of global factors. The thing that we can do is to take seriously your congressional order that we seek maximum employment. So in tight labor markets, workers are more likely going to be paid well and paid their share. I would say most of the factors that have driven down labor share of profits are really not under the control of the Fed. And so those are issues that we don't have control over.
But would you say that the tax bill did not affect those downward trend in wages positively? That it has, in fact, it's done nothing to reverse what you've seen as a decade or more of decreases?
I think wages are set in the marketplace between workers and companies, and they're affected by a range of factors. I think it would be early to be looking for a bill that was signed into law less than a year ago to be able to visibly be affecting much of anything at this point. Really, these things, big changes in fiscal policy, take quite a while to affect wages.
So none of this good news we're talking about today as a result of this tax bill. It's too early.
It's very hard to isolate the effect. I mean, I'd say wages have moved up meaningfully over the last 5 years. Has been quite gradual, and we certainly think it would be fine for them to move up more.
Do you think the European Union is a foe of the United States?
No, I do not.
Thank you. As we look ahead to some of the potential obstacles, and having both of us lived through 2008 and 2009, where it looked good and then it looked real bad. In retrospect, we saw some signs of the danger. What are the signs of danger that you're sort of focusing on? There's huge deficits, both government deficits, private deficits worldwide. You've got a trade battle brewing, and you've got things like Brexit that could complicate our life dramatically. So what are the 2 or 3 things that you think could throw us off this track?
There's a difference between the longer term and the short term. So in the near term, things look good. We look very carefully at a range of financial conditions and financial stability vulnerabilities. We feel that those are at sort of normal, moderate levels right now, although there are some areas that are elevated. Some asset prices are high, and there's an elevated level of debt in the non-financial corporate sector. More broadly, banks are well capitalized. Households are in much better shape. So financial stability, I don't worry about too much at this point, although we keep our eye on that very carefully after our recent experience. You mentioned trade. It's hard to say what the outcome will be. Really, there's no precedent for this kind of broad trade discussions. In my adult life, I haven't seen where essentially all of our major trading partners. Hard to know how that comes out. If it results in lower tariffs for everyone, that would be a good thing for the economy. If it results in broader, higher tariffs across a broad range of traded goods and services that remain that way for a longer period of time, that'll be bad for our economy and for other economies too.
Thank you very much, Mr. Chairman.
Thank you. Senator Rounds.
Thank you, Mr. Chairman. Chairman Powell, first of all, I want to thank you for being here today. Before I get into the questions, I'd just like to take note of the 2 rules that were announced this spring, the new stress capital buffer and the proposed changes to tailor the